Hello traders, welcome back to Nova channel and let's continue another topic for the technical analysis today. The subject matter of today's article is head and shoulders pattern, which we are going to examine on the chart and how to interpret its occurrence and what steps should be taken when it is confirmed. And now let's find out the meaning of the head and shoulders pattern. In technical analysis, head and shoulders is a reversal chart patterns that occur following a long upward price movement. There is also a bullish model of which pattern which is formed at the end of the descending chart and is referred to as the inverse head and shoulders. In the forex market, the head and shoulders patterns is extremely popular among traders since it is believed to be one of the most reliable trend reversal patterns. This pattern is indicative of a previous trend slowdown and the beginning of a new trend in the opposite direction. It's pretty easy to determine it on the chart. The head and shoulders pattern is comprised of three consecutive peaks. The one in the middle is the head, and the other two peaks on the other side slightly lower are the shoulders. The first peak is formed as a regular rollback during an uptrend. The price reaches a new high and rolls back. Once this happens, there is another movement exceeding the first peak under the pressure of the buyers. This peak must be the uptrend's highest point. After reaching the high, the price started to drop, forming the second bottom of the chart. At the level of the second bottom, the buyers become more attractive and start dictating the conditions in the market all over again. As a result, the price goes up, reaching a local high which is likely lower than the previous high. This last peak will be deemed the second shoulder of the graphic figure. In a classic example of this pattern, the shoulders have to be at about the same level and located approximately at the same distance from the head, although this is not compulsive. In order to identify it on the chart, you have to draw a line on the previous lows and reach by the price after the first and second peak or left shoulder and head. The neckline can be horizontal or slightly tilted upwards or downwards. We can talk about the trend reversal only when the price, after reaching the third peak, goes down and breaks the neckline, which serves as the support level. And now I will instruct you how to trade head and shoulders. When the third peak of the head and shoulders pattern appears on the chart, we can observe the further behavior of price when it is approaching the neckline. If it breaks the neckline, we should wait for the candle to close below this level. After that, we can start looking for the entries to open the sell deals. When we open the deal, the stop loss order has to be placed slightly higher than the peak of right shoulder. By measuring the vertical distance of the head to the neckline, we can determine a potential of descending movements. This will be the expected potential of the downward price movement. There is also another way to open a sell deal after a head and shoulders pattern has been identified. This method is the second chance for those who were not quick enough to open the deal immediately after the breaking candle closed and the price dropped. In some instances, after the price has dropped, passing a certain distance downwards, the rollback may happen on the chart towards the neckline, which has changed from support to resistance level following the breakout. If the price is unable to go higher and starts bouncing off the neckline, we can open the sell deal, place the stop loss order little higher than the rollback beyond the neckline. And now, in today's topic, I will introduce for you the inverse head and shoulders pattern as well. Next up, let's take a look at the inverse head and shoulders pattern in the technical analysis. This is the reversal pattern appearing on the chart at the end of a long downtrend. Its formation starts with the formation of the left shoulder, followed by the rollback and continued price drop below this bottom. As a result of this drop, the downtrend reaches a final low, where often the price goes up and the head is formed. This increase results from the closure of sell position and opening of the long positions by players. However, after a certain growth, the sellers still hope for a further price drop and believe that only corrective movements is happening in the market, which shall be followed by further drop. They start lowering the price until they encounter a strong pullback of buyers in the wait, which is followed by the price rise. When we see the price starting to go up again, we need to identify the point where the inverse head and shoulders pattern will be deemed fully formed. In order to achieve that, we should draw a line on the local highs which are located on both sides of the inverted head. When the price breaks the necklines from the bottom upwards and fixed above this level, we can talk about the trend reversal and the beginning of the upward momentum. We place the stop loss order slightly below the right shoulder and determine the price movement potential as we did in the previous example by measuring the distance from the head to the neckline. Another way to open the long positions is to enter at the price rollback to the neckline after the upward movement. In this situation, the neckline will serve at the support level. In accordance with the stop-loss placement rule, it has to be slightly below the neckline level, which is the price bounce up. In this article, we have examined two reversal patterns, namely the head and shoulder and its inverse copy. We have figured out when it occurs on the chart, how is it formed, and what the signal it provides for the positioning opening. And yeah, that's it the lesson today. Happy trading and see you in the next video.